Good morning from London. This is Bloomberg Markets Today. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. With the cash trade just less than an hour away, here's what you need to know. The yen hits a fresh 34-year low, breaching 156 after the BOJ holds rates steady and tweaks its language on bond buying. We'll bring you the latest reaction and Governor Ueda's press conference, which starts later this hour. Soft landing hopes dampen as the US economy slows and price pressures move higher. Traders pair rate cut bets as the focus shifts to PCE data due out today. Plus, stocks in Asia follow Wall Street higher after buoyant results from Alphabet and from Microsoft. We'll bring you the latest earnings from Europe with NatWest and Total Energies reporting.
In the meantime, more on the markets. You're seeing that green on the screen continue into the European session, at least early on. Eurostoxx 50 futures higher by 0.9%. FTSE 100 higher by about the same margin. The two-year yield, though, hit that 5% level, now at about 4.99. We're going to dive into the implications of the data. And, of course, on that currency watch, as Anna said, 156 handle on dollar yen. Markets today starts right now.
Good morning. Where are we? Friday the 26th. Friday the 26th. We have finally made it. A bunch of things happening right now that we will come on to and deal with more detail in just a moment. First of all, looks like NatWest has beaten with its numbers this morning. We've also got news out from Anglo American saying that the proposal that we've had from BHP undervalues its future prospects. And talking of future prospects, right on cue, copper hitting 10,000. So that's maybe reinforcing its argument that maybe it should be worth a little bit more money. The story, though, this morning largely centering around what is happening with the macro picture. We saw the US data yesterday. We get more of that a little bit later on. That is going to inform us as to how the Fed is likely to react at next week's meeting. But the immediate story, guys, is the BOJ. That felt quite dovish.
Yeah, I mean, and certainly the currency's continued to drop, hasn't it? And we've been asking all this week whether could we maybe get any kind of surprise. We didn't get a surprise, certainly not in the shape of a rate hike, and that had been only an outside sort of tail risk. But there have been some people asking whether we get that. I suppose with the economy expected to have been in contraction at the start of this year, we shouldn't be overly surprised about that. But, yeah, the yen continues to drop as a result.
It continues to drop, and I think we're talking a lot about monetary policy. The fiscal policy out of Japan matters as well as a lot. There are subsidies at play. There are kind of additional wage negotiations at play as well. So the concept of that perhaps another hike may materialize out of the BOJ by the end of the year is not an outside possibility.
Yep.
2 months ago, we might have said it was.
Yeah, and intervention, of course, the key focus of the day, but then that rubs up against US data, and timing of any of that will be really interesting to watch.
Press conference kicks off in, where are we? We're 3 minutes into the show, so we've got 27 minutes to go until the press conference starts. Is he going to be more hawkish, Ueda? I think it's going to be really interesting. It feels dovish at this point, but as we've learned from Jay Powell, things can change during press conferences, and maybe we can see pivots that ultimately change the market's direction. So we'll see. He could be hawkish. He could be saving that narrative up, i.e. we're watching very carefully what is happening. We are aware of the risks in terms of the imported inflation narrative around a weaker currency. There are various tweaks and changes that he can make.
Do we work this into the... I mean, I mentioned the US data because there's PCE out later, and a lot of people, every time we get a US data print and we're watching intervention, there's a lot of conversation about, well, if they're going to intervene, when do they do that? Do they do it after the data? Do they do it, you know, what do they time it against? And that takes us on to the US data of yesterday, which for some people was the worst of both worlds, really. The stagflation conversation perhaps back, as in we're talking about a weaker growth story out of the United States, which makes a change because we certainly have not been doing that over recent months. The day the music died was the way that Bill Gross summed it up.
I have issues with the weakness. I think there is. You look at the top line number, you can see that it's weakness. I tell you, there's a bunch of factors you need to consider here. Import data is surging, so you weirdly, and I know this feels kind of counterintuitive, but you back that out of the GDP number. So if you've got strong imports, i.e. the economy's doing well and you've got strong imports because the economy hasn't got the potential to satisfy all the demand, you back that out of GDP. Inventories, you back out of GDP. They're coming down. Again, a signal of strength.
Well, it's not just Guy who's not too worried about the weakness in the GDP. Janet Yellen also not too worried about the GDP.
I'm in good company.
Yeah,
they're
absolutely.
on the same team.
You are. She called them peculiar elements, and that you've described them, Guy. They're peculiar elements, and therefore she's not worried.
That does sound like Guy Johnson wording. Are you sure you didn't write that for her, Guy?
I'm moonlighting as her speechwriter.
I wouldn't be surprised. I think what's also important to keep in mind is as we're talking about this consumer weakness and the import-export story, is China is a key piece of this. And I think this folds in so well and so beautifully with the Japanese yen story, even the copper story as well, because as you're seeing weakness in the United States, how much of that is a China deflationary story as well that is kind of starting to seep into some of the data. A couple months ago, we had started to see economists warning about that deflationary read-through. If you look at the export data, you're already seeing that. In like the ports of L.A., for example, you're already seeing that read-through. That could be adding to some of the weakness. The other piece of it is the currency story. This idea here that you're starting to see these dollar longs position, that is adding to the yen weakness. That also adds, then again, to competition in the APAC region in terms of exports, again, to the United States. So there is kind of this trade in the EM world that pits the Japanese yen, the yuan, and the Korean won all against each other, all in terms of how the U.S. consumer is doing.
You get a solid print later. So yesterday, I loved the US data because it's really confusing. So you get core PCE data that comes out on GDP day because it's part of the GDP package.
Yeah.
And then you get the personal consumption and income data package, which comes out the following day, which is also, funnily enough, called...
Confusingly called PCE.
Yeah, deflator.
But it's today's one that the Fed watches.
It's today's one that the Fed watches. So yesterday's number definitely spooked the market. So yesterday's inflation data was strong. Today's the one you really want to watch. The market feels like, though, it is increasingly set up for a higher print, and we've backed yesterday quite a significant repricing of the Fed, so we've now taken the Fed to December, which I think is amazing. So we're not actually far from kind of pricing into 2025 now. But if you get a weak print today, I think the kind of the asymmetry around the reaction today is going to be interesting. I think the higher inflation number feels like it's increasingly priced. If you get a weaker print, maybe that's not priced. So maybe that's where the volatility comes in a little bit later on.
The bond story is really interesting as well.
The auction was terrible.
The auction was really, really bad, which is surprising given that earlier in the week the auction was actually pretty decent, that people were kind of buying out the yield. But I think it kind of creates a line in the sand, though. That 5% level that you're seeing on the two-year yield, that seems to be the line in the sand for a lot of investors. We've been talking about that in terms of the ripple effects for the stock market and globally.
Let's just get to some European earnings stories just to show we care. We got numbers out of NatWest.
We definitely care.
We got numbers out of NatWest this morning. No, I only word it like that because actually they're maintaining their guidance, and the numbers though do look to be a beat. So pre-tax operating profit better, impairment loss coming in lower than expected. What is really interesting, this whole sector, we've had Lloyds, we had Barclays yesterday talking to Venkat. It's all about net interest margin and the way they're managing that. There's a lot of talk in the sector about structural hedges and the way that these banks are able to delay the impact of some of the negatives whilst bringing forward the impact of the positives in terms of rate changes. We talked about the volatility and the gilt story with Venkat yesterday, and that's been something that's been really, of course, on the minds of these businesses. But government stake sale, we don't have any more update there. I guess that's not in the hands of the NatWest management. But you've got to wonder, with the shareholding down to less than 30% already, are we going to get some kind of big sale? They just keep drip feeding it into the market this way. Still
feels like a fairly chunky overhang in terms of the stock. The other thing I would flag as well in NatWest is that the Q1 impairment loss was 93 million. The estimate there was 174.
So better.
So much better. Have you seen the consumer confidence data out this morning? Ticking a little higher in the UK as well, maybe suggesting that actually the UK economy maybe is stabilising, albeit at reasonably elevated rates.
We've also got numbers out of Total Energies.
Interest rates, not economic rates.
Right. We've got numbers out of Total Energies, adjusted net $5.11 billion. That is just ahead of the estimate of $5 billion. I was entirely distracted in my preparation for this earnings story today by a note out from Javier Blas, who's been keeping us focused on listings of big energy businesses in Europe and whether they're tempted to go to the US. And he says that he's talked before about Total. This time he's talking about he's talked before about Shell. Now he's talking about Total. It's been listed in Paris since 1929.
Yeah.
Could it go to the US? And he's suggesting that both of those could move within 5 years.
Can you guys rant on oil multiples?
No. I'm going to talk about yogurt.
Oh, yeah. No,
naturally.
Exactly. There'll be pushback. There'd be pushback.
If Danone is strategic, what do you think Total is?
Yeah, absolutely. I mean, there you go.
Gas and energy have proven to be very important strategic assets. It would be unlikely the French government would be particularly taking a laissez-faire attitude towards the movement of large French energy stocks to the United States.
They're also planning a $2 billion buyback in the second quarter.
That's exactly what I was going to say. And it's not the only company, by the way. Isn't that the story out of Alphabet as well? Good earnings in the tech story as well, out of Alphabet, out of Microsoft. We can go to the nitty-gritty, but the first ever dividend coming out of Alphabet, 20 cents a share. On top of a $70 billion stock buyback. Even if the numbers were poor, even if they didn't have that AI market share and the cloud boom there, that would still be a stock to buy just off that capital returns. But they did, which is why you saw this massive move in the stock.
Yeah. Are we down to the Magnificent Three now? Is it Alphabet?
Are we losing them that quickly?
Is it? Well, it kind of. You think about what happened last night. It was Microsoft, Alphabet, Nvidia's not had a great week. Take a look at Nvidia this week. It's not had a fantastic week. But you kind of feel we're down to Alphabet, Microsoft, and Nvidia at this point.
It's a scratchy week.
We're losing them fast.
We are losing them fast. But on the subject of Alphabet, this has been a business where the cloud, Google's cloud product, has lagged behind some of its competitors, the likes of Amazon and Microsoft. And then last night we did get that evidence, to your point about the numbers, they did deliver. And the AI side boosting the cloud part of that business. And obviously AI was a feature of the Microsoft story as well.
Well, the Google part is also significant here because this is only the second quarter that they're actually profitable in this particular unit. And it, I think, came out at $900 million. The estimate on Wall Street was about $621 million for the quarter. So they've shown this profitability. But the issue with Alphabet is that they have a lot of ground to make, to your point. The dominant players here in the AI and in the cloud space is not Alphabet. It's Microsoft, it's AWS. And by a massive margin, Alphabet actually more directly competes with Oracle for cloud share than it does with its magnificent peers, if you will. The fact that they are now profitable by this much of a margin, by the way, and almost 50% excess margin that they were expecting, helps them get to scale even faster and even make up that share even faster.
The numbers are eye-watering. You look at how much these businesses are spending on it. Unbelievable figures. And it's just, they are juggernauts in terms of their spending right now.
One of the things, though, to really keep an eye on and keep very, very carefully is that this is still the early stages of the investment. So when you do have this early ramp up, the numbers are enormous.
Yeah.
Right.
And it seems that investors actually have quite high tolerance for capex on AI in a way that maybe they didn't for capex on other moonshot projects.
Yeah.
And I know moonshot's the Google term, not the Meta one. But, we had a Meta shareholder on just days ago being very critical about previous rounds of capex, but not this one.
Yeah, and Microsoft had the same problem with Azure, right? And they've continued to say every quarter people are saying, is this the time that it snaps? And it doesn't because of the massive growth rate. So we're going to dive into that throughout the rest of the show. We have plenty more to say on that, but there's a couple of other things to watch out in today's session as well. About 10 a.m. UK time, ECB's Mario Centeno will be speaking at an event in Frankfurt. We'll be keeping an eye out for any commentary coming out of him as well as the ECB. 1:30 p.m. London time, of course, that U.S. PCE data that we're keeping an eye on. 3 p.m. UMISH consumer sentiment data. Guy, I think you said it is
I think it's the final read.
It's the final read. It's not the preliminary read. So we'll see how tradable that is, but still something to put on your radar. Plus, phase 2 of the Indian parliamentary elections begins. And, of course, Anthony Blinken is in China. So any commentary there is going to be crucial. Plus, of course, those big oil earnings coming out later in the U.S. session. ExxonMobil and Chevron, top of the docket.
Yeah. We can talk about multiples. We can compare and contrast.
I keep waiting for you to do it, and you're not delivering.
I know. I want to talk about yogurt. It's Friday after all.
Don't you want to talk about airplanes?
We can talk about airplanes. Airbus last night was in. I got to talk to Guillaume Faury, which is always a pleasure. And it's interesting there. They are. If you want to see a supply-constrained business, take a look at what is happening with Airbus right now. Most businesses have sorted out their supply chain issues. The aerospace industry is struggling beyond belief to sort out its supply chain issues.
It feels like a new normal now, though, doesn't it?
Yeah.
You can't now say that this is a sort of COVID thing.
No. This is the problem.
Yeah, this is a new normal in this
So
sector.
I think it's taken them a long time to come back because it takes a long time to train somebody to build an aeroplane. You kind of want it to work.
Yeah, want them to get that right.
Yeah, we've learned that lesson recently. And so it takes a long time to bring people back. And the supply chain has had the same problem. And they went through... There was a long time in which the supply chain was kind of squeezed. We need to take kind of costs out of the supply chain. That is now a real struggle. And there used to be the idea that Airbus would also recruit out of its supply chain. That's a real struggle as well. But they're also trying to ramp production.
Yes.
So they're also seeing huge demand at the moment. So you've got the supply chain squeeze and you're trying to ramp production at the same time, which is challenging.
Yeah. And then that, because you have to prepare for just in case instead of just in time when you're trying to ramp up production, that weighs on cash flow, weighs on your working capital. And that's what we saw out the Airbus numbers yesterday.
Huge. They call it an inventory buffer. They're talking about a buffer because they want to carry so much of this stock. Now, part of that is due to the ramp. So they're ramping up production, so they want to carry more inventory to make sure that that ramp can deliver up to the higher 75 rates. Is it a good news story because demand is there, or is it a bad news story because the effort to get there is so hard?
See, it's a very exciting morning. We're talking
It is.
planes, we're talking supply chains. We are going to talk a lot of other things as well, though. Coming up on the programme, a French study by the former Bank of France Governor, Christian Neuer, calls for urgent action to deepen European capital markets. We will have an exclusive interview with him at 8:30 a.m. London time. Could we finally be turning a page from Capital Markets Union? We'll see. Plus, we speak to Charu Chanana of Saxo Markets, who says yen intervention without a hawkish BOJ will be futile. That interview coming up at 7:30 a.m. UK time. We'll bring you the press conference around the BOJ, of course, as well. If you have questions for our guests, if you just want to get in touch with us, if you want to talk to the team that puts together the programme, IB plus TV Go is the function to use on the Bloomberg. This is Bloomberg.
This is not a worrying report for the Fed. That is telling the Fed that those interest rate increases may be having some effect in slowing demand, particularly for goods, but it's not alarming by any means.
I don't see why the Fed would be, rushing to be cutting rates into an environment where inflation is still sticky. That was true 3 months ago. It's true today.
T. Rowe Price Associates Chief U.S. Economist and Stifel Financial CEO. They're speaking on that resilient U.S. economy. Let's get a little bit more analysis here. Eric Nelson, macro strategist over at Wells Fargo, joins us this morning on set. Good morning. We're seeing consumer resilience. You just heard sound that the U.S. economy is doing great. There was a data dump yesterday, and the markets reacted as if it was the exact opposite. Was that warranted?
I don't think so. I think the market's been waiting for that sign that maybe the U.S. economy is starting to roll over. We just didn't get it yesterday, right? You look at the details of that U.S. GDP report. Yes, consumer spending was relatively resilient, but look at residential investment, housing investment. It was up almost 15% annualized.
Yeah.
So rate hikes, have certainly had some impact. You look at the level of residential investment is still low, but it's starting to recover from a very low base.
That feels like it speaks to just a lot of excess stimulus that's still working its way through the system for Americans to be able to make that kind of investment. Is that the right read?
That's a big piece of it, yeah. And also, you just look at regular income growth, right? So margins in the corporate sector have still been pretty high. They've come down, but they're still high. And so the labor market's been strong. Income growth's still strong. Yes, immigration is supporting that, but also the margin in the corporate environment is still relatively healthy. So that's keeping the consumer going. That's keeping the housing market going and the U.S. economy overall.
OK, Eric, good morning. So we don't worry too much about any weakness in that GDP number. There are the reasons we've talked about a couple of times then as to why those don't matter or might be transitory. Janet Yellen also not worried about the pickup in the type of inflation print we got yesterday. There are many inflation prints available. We get a different PCE today. But she said, I have no doubt that the contribution coming from housing costs, that component will be falling over the coming year. So any concerns around stagflation then, we just shouldn't have them?
Well, certainly not stagflation. The bigger concern here is that the economy is just too hot. So strong growth, strong inflation, right? That's the challenge for the Fed here. We'll have to get a real sense of what the Fed's thinking next week. So, the Fed has tried so hard to explain away some of these inflation readings, the relatively strong growth readings. It's increasingly difficult to do that. And I think next week we may start to see a more perceptible tone shift from the Fed on these inflation readings.
So you think we might get a pivot on the pivot? So if the first one came in December, this is a pivot on that?
Well, the challenge is they're expected to announce a slowdown in the pace of quantitative tightening next week. So if they just do that and sound dovish on rates in the face of these inflation readings, it's becoming a little bit difficult to make that kind of policy announcement with the current inflation backdrop. So I think the hawks on the committee may start to hold more sway.
When does the market start to perceive dovishness as a policy mistake and react at the long end by sending yields higher? Like, to a certain extent, that's already happening, but how much more could there be?
Well, again, it depends on if they continue to sort of say the same thing over and over again, which is, we're just going to push rate cuts further out. So two more months, 3 more months, just give us more time. In the face of these inflation readings, that becomes at a certain point less and less credible. And I think you look at the dollar's reaction yesterday, that was really interesting. It didn't make any sense to me that strong growth, strong inflation, the dollar went down. But, to not see further dollar follow-through yesterday is really surprising.
Rates don't slow the economy down, I think is the lesson we're learning. Financial conditions are the biggest kind of impact on how the U.S. economy performs. Financial conditions are super loose. They remain super loose. The pivot back in December probably had an effect on that. Does the Fed now need to start knocking asset prices to get financial conditions back under control and have some transmission into the economy in the way that rates are not doing right now?
Well, I do think that rates do have an impact. I think what's different about this cycle is what's driving. You look back at 2006, 2007, credit-driven, it was variable rate mortgages. High rates had a very clear impact. High rates do have an impact on businesses. They do have an impact on consumer credit, credit card delinquencies. There's some impact. It's just being completely swamped by the fiscal and the income growth. And I think to your point, what you need to see is more time at relatively higher rates, probably 5, maybe 5, even higher than that in the long end. That's the kind of thing that will have an impact eventually, but the Fed needs to change course for that to happen.
Can we zero in on the income growth piece of this? Are you making the argument, and correct me if I'm wrong, push back please, that because there's higher corporate margins, that's actually bleeding into real wages?
More to say that because margins, we're in a classic labor hoarding environment right now, right? Hiring has come way down, but you look at jobless claims yesterday, they're extremely low. So firms do not feel compelled to lay off workers. They got burned in 2020 doing that. And the margin environment is so strong that they don't have to, right? Even though you are starting to see, a little bit of pressure there. And I think that's really keeping the labor market strong. So overall, job growth is still strong. Wage growth has slowed a little bit, but in aggregate, given how strong job growth is, labor income growth is still really solid in aggregate.
Understood. So then talk to us about the stimulus piece, the other part of the equation you mentioned. When does it run out? When do we stop seeing the effects?
Well, certainly we have started to see a lot of the tailwind fade on the federal side, but take a look at the state and local contribution to U.S. GDP in the last five or six quarters or so. That's really strong, right? And you look, it's the exact opposite of 2009 and 2010. So you're still getting the tailwind from different places on the fiscal side, and I think that's really underappreciated.
Eric, we're getting very excited about tech earnings and AI, and it's been a bit of a messy week trying to untangle, the winners and the losers, and Meta hasn't had a good week, others doing much better on the AI front. We deal with it very bottom up. We're talking micro. From a macro perspective, are you seeing impacts yet? Is there anything to say about AI just now?
I think it's a little bit too early. I think a lot of the AI boom has certainly coincided with a productivity pickup, but if you dig into the data, you haven't necessarily seen that so much in terms of what's actually driving the productivity, driving the investment. A lot of it is, again, the fiscal, right? We've had a lot of investment, CHIPS Act, the IRA, all these things that have contributed to real, genuine investment in the U.S., and that is a big driver of this productivity bump.
What does this mean for the rest of the world? You got the BOJ today struggling, currency weakening dramatically, other Asian currencies weakening dramatically. We're kind of on tenterhooks waiting to see what's going to happen in Europe. If the US continues to power ahead and the Fed doesn't move until December, maybe even 2025, what breaks? What's the economic ripple that you're thinking about, the waves that are going to spread out into the rest of the economy, and is that imbalance going to grow, US versus the rest of the world?
Well, certainly a strong dollar has a negative impact on a lot of the world, right? I'm thinking about emerging markets who are borrowing in U.S. dollars. The whole world is effectively short dollars in a way.
Yep.
I think from a growth perspective, there's already economies within the G10 that are starting to show some cracks. Sweden, Canada, they're more reliant on variable rate debt. And I think if those economies are kind of dragged into keeping rates higher for longer because of the Fed, that becomes more of a problem for their economies.
Eric, great to see you. Thanks for stopping by to see us on this Friday, digesting all the data that we've got. We get more of it a little bit later on. We get the personal income data package. That's going to be coming out. We'll be watching very carefully what is happening with those numbers because the Fed will be watching very carefully what's happening. We will also be, I suspect, having the Japanese watching very carefully. The yen hitting a fresh 34-year low. The BOJ holding rates steady. Tweaks to its language on bond buying also coming through. Chero Chinada, head of FX strategy at Saxo, is going to be joining us. We are 3 minutes away from the BOJ presser. We'll also bring you details of that. This is Bloomberg.
Welcome back. This is Bloomberg Markets. Today you're looking at live pictures coming from Tokyo. This is the governor of the Bank of Japan, of course, Governor Ueda, speaking at that press conference, the event that usually follows the decisions around monetary policy as it does today. No change in monetary policy, at least no change in the interest rate from the BOJ. They tweaked their bond language, of course. It wasn't enough to put a line under in the sand under dollar yen. We're at 156. We're back down to 156 once again. So weakness in the yen, weakness we haven't seen since 1990. We're watching that very closely. That's part of the conversation around Japan. We're also focused on any intervention that might come from the Japanese authorities, because this weakness in the currency is not a new story, and it does put certain strains on an economy. So we'll monitor the press conference. Governor Ueda just kicking things off then in Japan. As that continues, we will get to our next conversation. Our next guest says that any intervention by Japanese authorities without the support of hawkish policy messaging will be futile. Joining us now is Charu Chanana, Head of FX Strategy at Saxo Markets. Very nice, Charu, to have you with us. So, I mean, this is a point that a lot of people are making, that the weakness in the currency is being driven by interest rate differentials, and they're big. And any language around watching with vigilance or any similar language, what's going on in FX markets, or indeed any tweaks to monetary policy, not really changing the narrative around those interest rate differentials. What's your view?
Yeah, I mean, actually, looking at the statement today, Anna, it was really a surprise because there were some expectations that were built up because of the comments that had come through in the last few days that the BOJ statement would address the impact of FX on inflation. And also there were, I would say, a small part of the market that was expecting that because of that likely impact on inflation, the BOJ policy stance, language, or its bond buying strategy could shift in a little bit of a hawkish manner. But the statement has been so bland, right? I mean, it could obviously mean that Ueda wants to stress a lot on direct communication. You see the size of this policy statement as well. The length of the statement has been so short as well. So it certainly looks like there are some changes coming. But if they're going to take it that slow, and given that the US side of the story is dominating where dollar yen goes, it certainly looks like for them to reverse this trend in dollar yen will remain very, very hard.
Sticking with the rates conversation, we see Governor Ueda, he's delivering these comments this morning. He's saying Japan's economy is recovering moderately, and his weakness in the Japanese economy, the big thing that stands in the way of another rate hike, because we've had the end of the negative interest rate policy in Japan, but we haven't seen a series of rate hikes yet, and maybe, you know, that's what some people are waiting for.
It's very difficult for the Bank of Japan to go on a series of rate hikes, as you call it, right? They have fiscal concerns to be cautious of. And if you just look at that Tokyo CPI print that came out this morning as well, I mean, it was considerably weaker than expectations, than the previous month as well. Although, of course, there were some one-off items in there that played a part. But certainly doesn't look like we will continue to get those macro conditions that could support another rate hike as well. I mean, you know, I think it really remains difficult for Bank of Japan to move at an accelerated pace, also considering the kind of impact their moves would have on global bond flows, right? I think that is something that they have to be really cautious of as well. So if anything, again, I mean, going back to dollar yen, the move really has to come from the US side to bring a really sustainable recovery in the Japanese yen.
Charu, good morning. It's Guy. So what do you do if you're the Ministry of Finance in Japan and you're watching the yen ticking lower and lower and lower? Where's the line in the sand? Like Ueda just said, we need to watch the FX and its impact on inflation. This is going to add to inflation. The imported inflation story is going to be significant if we keep going at this kind of a rate. When do you do something about it if you're the Ministry of Finance? When do you take action? Is it after the US data today? Do we wait a bit longer? What is your thoughts on that?
It certainly seems like they want to remove that mentality around lines in the sand and really focus on the pace at which we are seeing this deacceleration in the Japanese yen. So earlier it was the 152 level in dollar yen that was being watched, then 154, 155 now. Certainly all these levels have been cleared without even, I would say, the narrative taking a leg higher at this point. So it does mean that we could test the limits of the Japanese authorities here. if you go back to some of the comments that we got from the FX chief in Japan earlier, he said that a move of about 10 yen in a month against the dollar, that would be the threshold for intervention. We're not there yet. The early April lows were about 150, 151. So we have to get to really 160 for that to be a concern. And if we don't get to that by the time we get to next week, then again, the threshold goes higher. So I think it really depends on the pace of the move rather than the levels themselves at this point.
But your theory would be that if we don't see more hawkish narratives emerging from the authorities in Japan, the BOJ, that if we do see intervention, the right reaction would be to sell the yen on the back of that after the initial move has faded, i.e. it's an opportunity to work against the yen rather than kind of retreat from that position.
Right, absolutely. That's exactly what I'm trying to say, Guy, because as I said earlier, the sustainable move lower in dollar yen or a sustainable strengthening of the yen can only come from the US side, where we start to see some economic weakness in the US, some more signaling on Fed rate cuts. And I think we're just getting further and further away from that rather than getting closer to that at this point. The BOJ can only cover a very small distance in that yield differential that we have from 0% to 5.5% from the Fed. They can cover a very small part of that distance, right? So any move from the Japanese authorities in terms of an intervention, they either have to be coordinated, with Korea, like we got a statement, with Janet Yellen. That could make the move a little bit more sustainable, or it has to come with that turn in the Fed policy, which we're not there at yet. So I would think the markets would continue to position to fade the move if we were to see a strengthening of the yen on the back of an intervention.
Charu, it's Kriti in London. It feels like at the core of this argument that intervention is going to come is that once it happens once, it sets a precedent for it happening over and over and over again. Is the BOJ, and by extension the Ministry of Finance, do they have enough cash reserves to do that? What does that look like?
I mean, they could have the cash reserves, but again, like you said, it is going to be an endless amount that they need. And as long as the yen continues to be driven by the US side, you had this whole GDP data coming out this week. Now the focus is shifted to the March PCE number due today. Going into next week, we again have factors like the Fed policy meeting or the quarterly refunding announcement from the Treasury side. All of those continue to point towards more upside in Treasury yields. So even spending a penny here on intervention seems futile to me. I mean, I don't even want to look at what reserves they have left to really make an effort.
I think that's a fair argument to make. Charu, as we speak to you, we are getting more lines coming out of course. Governor Ueda really harping on the FX story, saying it could be a vital factor to affect inflation, but that monetary policy is not targeting control of FX, but of course they will be monitoring those impacts. Charu, talk to us a little bit about whether or not the yen even functions as that classic safe haven currency anymore, given the macro environment that we're in. Do capital flows have any bearing on what the yen does?
That's a very interesting question, Kriti. And I would like to emphasize here that when you're trying to find a safe haven for your portfolio, you need to understand what kind of risks you are hedging, right? If it is the geopolitical risk that you're hedging, then, it really comes down to the fact that whether treasuries can continue to be a safe haven, because the whole safe haven aspect of the yen was being driven by the fact that Japan has large holdings of U.S. treasuries and they are a safe haven. But given the kind of fiscal environment we are in the U.S., the rate volatility that we are seeing in the U.S. in the long end, it surprises me that we can still consider the long end treasuries as a safe haven. As a result, the Japanese yen cannot be a safe haven unless the bid comes through in a sustainable manner to the treasuries as well.
Charu, great to see you. Thanks very much indeed for jumping on and giving us some instant analysis at the start of the BOJ press conference, which, as you can see, is ongoing. Charu Chinana, head of FX strategy at Saxo Markets. Quick recap, there's a line that's coming out which I think is really worth paying attention to. FX could be a reason to mull policy if affects the price trend, i.e. you get imported inflation coming through as a result of this weak yen that we are seeing. A couple of things I want to mention. First of all, if you want to listen to what Ueda is saying, you can do so on your Bloomberg terminal. Live Go is the function that you can use to make that happen. The other thing is there is a fantastic live blog that is currently running that will give you all the insights and analysis as to what is being said and its implication for the market. So all of that available on your Bloomberg. We'll continue to monitor what is happening with that press conference, but we're going to move on as well. We're going to talk about tech. Microsoft and Alphabet reaping the rewards of their AI spending spree. The earnings were strong last night. Are we down to the Magnificent Three? We're going to talk about that next. This is Bloomberg.
Welcome back to Markets Today. We are 17 minutes away from the start of cash trading here in Europe. There's a lot going on in the Asia session, though. We've been through the BOJ story. No change in rates, and the yen continues to slide. That's the headline, really. 156 is where we trade. Let's talk about where we are on these markets in 2 minutes with our Markets Live executive editor, Mark Cudmore, who's with us this morning. Mark, any change to your thinking then in on the Japanese currency? Any thoughts on timing of any intervention? We were just hearing from our guest about the futility of intervention if the US doesn't do something that changes the dynamic on interest rates.
Yeah, good morning, Anna. No major change. I am still structurally very bearish the yen. I still think that if the MOF come in and intervene, the discretionary macro hedge fund community will excitedly use that intervention as a chance to just sell yen at better levels. I don't expect intervention. Obviously, it's a risk if dollar yen is much higher by tonight. I'm told by some of my colleagues, some smart colleagues in Japan, 157.60 might be the level to watch. I kind of think it's got to be somewhere near 160 probably before the MOF is going to intervene when we're in a world of where US yields are going to continue to drift higher.
OK. There's so much to talk about this morning, Mark. Let's go from what's going on in currency markets to what's happening in metals. Copper hitting $10,000 a tonne in London for the first time since 2022, which isn't that long ago. But interesting dynamics in this market, given the M&A excitement in the market that we covered a lot yesterday. I know your colleagues have been writing about how the short-term direction might be a little opaque. I think this was on the Markets Live blog just yesterday. But maybe the medium-term dynamic a little more solid in terms of the copper price. And we all know that this is an important metal for transition. What do you make of this latest move higher in copper?
Yeah, look, I think that the $10,000 is just symbolic, as those lovely round numbers, gets great headlines, we all get excited, but it's a little bit of an arbitrary level. The backdrop story here is that we're still seeing an incredible reflationary dynamic in commodities. And like, while some of the gains have come out of oil markets, which is kind of the benchmark one to watch, and obviously the most important commodity, the fact is the Bloomberg Commodity Spot Index is right up at the highs and has just seen incredible gains over the last 2 weeks. In fact, other commodities are gaining so much that they're making up for the fact that oil prices have pulled back from the highs. And this is another dynamic that is going to feed through to yields. It's going to feed through to yields in a couple of months. So when we stop running out of kind of the upward momentum from the Fed readjustment, we'll get another one from commodity inflation.
Yeah, it's all sounding a little higher for longer, isn't it, Mark? Thank you so much. Bloomberg Markets Live executive editor Mark Cudmore joining us there. Remember, you can get the Markets Live blog on the Bloomberg terminal. MLIV Go is the function to use. You'll hear from Mark and all the other members of the Markets Live team.
Let's talk about AI and figure out exactly what is happening on that front. Strong AI demand has been cited as the key driver for positive earnings that we got last night from Microsoft. We also got them from Alphabet. The CFOs of both of the tech giants, it's Friday, it's been a long week, expressed optimism on their earnings calls.
Pleased with our financial results for the first quarter, driven in particular by strength in search and cloud, as well as the ongoing efforts to durably re-engineer our cost base.
In FY25, that focus and execution should again lead to double-digit revenue and operating income growth. To scale to meet the growing demand signal for our cloud and AI products, we expect FY25 capital expenditures to be higher than FY24.
Are we down to the Magnificent Three? Kind of felt like it after last night. Alex Webb joins us to give us some perspective on what we saw yesterday from these two businesses. They seem to be figuring out a way to at least turn the spending into something real, which I think is a critical differentiator between some of the companies that are spending huge amounts of money. Meta versus Microsoft feels like a different story at the moment. are we beginning to kind of sort of titrate out the differences between these companies and beginning to figure out who's actually going to win in the AI race and who's going to come second, third, fourth and fifth?
I mean, certainly in this first wave, where it is very much an enterprise product, and of course, for Microsoft and Google, they have platforms on which to build that enterprise product through which to sell it, namely the cloud, right? Meta does not have that. Meta is consumer-facing. Obviously, its product is for the enterprise, it's advertising, but it is just advertising. Google and Microsoft, they are selling a lot of AI functionality to big companies to use on their clouds. We've seen with Microsoft about 5 percentage points of the cloud revenue, a little bit more than that actually, 7 percentage points of the cloud revenue in the most recent quarter was attributable to AI. So it is in that part of the business that they have an edge.
When we're talking about that edge, though, there is a real competition dynamic between Alphabet and Microsoft in getting that cloud demand. How much progress can Alphabet actually make, given Microsoft's kind of dominance in the space?
Well, that has been the question for Google's cloud for much of the past decade or so, really. What we're seeing now is they are starting to penetrate, and it's AI that is letting them do that. When we think about the real leaders in this space, it is really OpenAI and Google, and there are a bunch of other companies coming up, not least Anthropic, which has a relationship with Amazon. Don't forget, Amazon is the big sort of, whatever, 300, 400-pound gorilla in the room.
Yeah.
But Google was predicted to have $600 and something million of profit from the cloud in the quarter. It had $900 million. So it's a huge beat just from that business. It is really starting to penetrate in a way that it hadn't been before AI came along.
Yeah, creating new gorillas, perhaps. Not so much the case for Meta. I mean, that's a business that's had a very difficult week. Why is that business not managing to turn this new technology into something it can monetize?
Well, I think, firstly, is the reasons I said, that it doesn't have the same enterprise-facing business. But I think, secondly, I think some of the problems we've seen with Meta have partly been about communication, really, that they're expanding their CapEx on particularly AI-type things they need for AI revolution, data centers, personnel, that sort of thing. But the stock has more than doubled over the past 12 months. We've not seen that same expansion at Google. But the telegraphing at Meta was very much, we're going to keep our costs under control. This is not going to be, we've had a year of efficiency. At Google, we didn't really hear any of that. They did cut jobs. They did actually introduce more of a focus on costs. But the communication was a little bit more cautious than what we saw at Facebook.
Nice to see you. Thank you very much for stopping by to see us. Alex Webb, how much of this AI stuff is actually going to turn into a viable business model? I think is an open question. Let's talk about some of the other stocks we're watching here in Europe this morning. We've had a whole range of numbers out over the last 24 hours. Kind of started last night with Airbus. We move into NatWest this morning. Let's pull it all together with Joe Easton.
Morning, guys. So Airbus has raised its output target for the A350 wide-body long-haul jet. They now expect to produce around 12 jets a month from 2028, above the 10 jets a month previously. And that is something that could potentially help the stock outperform continuously versus the old rival Boeing. That is something that we have seen. And a lot of analysts do have positive ratings on this, around 20 buy ratings versus just a single sell on that stock. However, it did get more negative further down in the statement and on the analyst call as well, with the company actually warning of continued supply chain issues affecting their ramp up, limiting their ability to produce more jets, and also the geopolitical situation also weighing on the earnings. And as such, the EBIT, the earnings before interest and tax, did actually miss expectations. And as a result, we saw a drop in the ADR, the US stock, overnight. So that one did fall 4%. Potentially, that outperformance versus Boeing won't continue in the short term, at least. Then we're looking at the big M&A story of the week, Anglo American. We have got an official statement, finally officially rejecting the takeover proposal from BHP, and they are quite strong in what they say. So they say that the proposal is opportunistic and fails to fully value Anglo American's prospects, and they also take issue with the structure of the deal in this quote here, saying it's highly unattractive and creates uncertainty and execution risk for Anglo American shareholders. Now we'll take a look at what the stock did following this approach. We can see that huge jump, and analysts are noting that it actually trades above where the implied takeover target price would be. potentially showing that some analysts and traders expect a higher bid to come in for that one. We're going to take a look at BHP as well over in Australia, because that one did drop around 5%. It had the biggest decline in 7 months overnight on the Sydney Exchange, according to our data. There it is on the screen, down 5.2% for BHP. Finally, here in the UK, we've got NatWest. Pretty positive across the board here. The net interest margins are in line with expectations. Profits doing pretty well. This stock has had a bumpy ride over the past year, with the CEO leaving following the fallout with Nigel Farage and the Coutts bank account. Here's some of the main things on the screen here. Signs of improving consumer confidence. As I say, net interest margins stable. The stock has rallied about 65% since an October profit warning, though, so potentially some of that positivity priced in. Keep an eye on NatWest over in London.
Joe, thanks very much. Equities reporter Joe Easton with the latest on all of those names to watch at the start of trade this Friday morning. Let's get back to the Japanese story. Governor Ueda still speaking at the BOJ. I'm drawn to lines that put the FX story front and centre with regards to monetary policy. Weak yen not having a big impact on underlying prices yet is one of the lines he gave us some minutes ago. And then saying the impact of FX moves on inflation is usually temporary. So, if you're looking for reasons why they won't be in a hurry to intervene or desperate to intervene, then you can see some. But obviously other views also coming through in this press conference this morning.
It's interesting how he's talking about the FX. He clearly doesn't feel that the FX story yet is at the point where it's going to have a material impact on inflation. At what point does that become a problem, and how does policy react to it, I think is a question that I think he's trying to still figure out.
The two lines that stuck out to me that are still rolling out is, he said the impact of the FX move on inflation is temporary, which is exactly what the market is saying. It's not temporary.
Exactly.
The oil price has not been mentioned yet, which is significant. It's historically been a big weight on that. He also says that they're using bond buying as a policy tool, which I think is interesting because they invented bond buying as a policy tool.
He says he doesn't want to, does he? He wants to roll that back. Nomura's CFO saying they expect the yen weakening to correct when the Fed cuts rates, which goes back to the conversation we were having with our guest earlier on this hour, saying that this is actually in the hands of the US rather than the Japanese. Now, coming up, we'll have the market open for you. We'll get you the latest on European trade. It's been a busy week. This is Bloomberg.
Friday the 26th. Welcome back, folks. Lots to talk about this morning. We have, obviously, the macro story that is unfolding. We have data out of the United States a little bit later on. Right now, we're dealing with the Bank of Japan, but we also are building our way towards, in a minute and 40 seconds, the European equity market open, which feels, relative to the last few days in terms of the volume of corporates that we're having to plug in to these numbers, like we're on a little holiday this morning. We've got NatWest to deal with. I think we've got a little bit of the mining story to fold in, but it hasn't felt quite as fast and frenetic.
Feels a little more casual, doesn't it? But yes, NatWest could be interesting, beating estimates, growing consumer confidence, back to your point from the top of the programme, that we are seeing that story develop here in the UK. But really, it is a day where we're focused on the macro, and we've been focused on the BOJ, that press conference at the BOJ ongoing, and a bit of movement in FX. Yeah, we are seeing a little bit of pop in dollar yen as well. Remember, it's gone through that 156 level. We're still kind of seeing what the reaction is too. But the latest headline coming out of Governor Ueda is simply that they're very close to stable inflation if their outlook materializes, which really, to me, just seems like they're saying, if all goes to plan, we will also execute as we've been forecasting, which to me seems like a little bit of nothing burger, but standard central bank language. I was about to say, but it's something that the markets seem to be reacting to. Of course, dollar yen 156.36 at the moment.
So a couple of stocks that are worth watching. Total, I think, is going to be interesting. Looks like that's going to be called higher this morning. Amundi, the inflow number actually really strong over at Amundi, which I think is worth paying attention to as well. AMS Osram, which has had a terrible run recently, and looks like the revenue line has beaten. That could be a little bit of a pick up as well there. We're seeing maybe some sort of bottoming out in some of the European chip story.
In terms of the tech names, we'll certainly look for a bit of whipsawing in that sector, because this time yesterday, we were all weighed down by doom and gloom around Meta. Today's a different story from the likes of Alphabet and from Microsoft. So NASDAQ futures are higher. Where will that leave the tech sector, which was on the back foot yesterday, down by just over 1% in Europe? So European equity markets just opening up then. The FTSE 100 is pretty flat, but just out of the gates this morning. Waiting for others. The DAX is open now, up by 0.1%. In terms of where we are across these European equity markets, then seems, yes, we are getting that bounce back in technology. So it was one of the sectors under pressure yesterday. That was the Meta effect. We now have a different story to tell. We've got very short-term memories, it seems. So we're over Meta and we're now into Alphabet and the Microsoft numbers, the potential of AI to deliver really front and centre. And so we see the technology sector the best performing here in Europe this morning.
Airbus is down, unsurprisingly. Actually, the ADRs got hit a little bit more last night, so Airbus is only down by 0.6% at the moment. Worth mentioning, there's a whole bunch of XDs in the market today. So you've got ABN AMRO going XD, BASF is XD, Munich Re, L'Oreal. L'Oreal, at the moment, is the lead loser in terms of the points impact on the 600, but it's gone ex-dividend. So that's worth mentioning.
Can we talk a little about this commodity move here as well? Some of the bigger index contributors, at least, is Rio Tinto and Glencore as well. Glencore, I was just looking at their numbers, about 12% of the revenue to that copper exposure. So I wonder if there's a macro read-through into some of the miners here this morning that you're seeing. It's starting to pare back a little bit, but you did initially see that move. I'm not getting an opening price on BHP yet, though, so we will see what that looks like after the news that their offer was basically rejected from Anglo American.
Yeah, there's a number of lines on the basic resources sector, aren't there? There's the nervousness to perhaps around who's going to come in next with what for Anglo, and how messy will that get? How expensive might that asset become if it gets complicated, and if there are other players looking to get hold of it? And there are all kinds of complexities behind that. We talked about that yesterday. But then on the other side, there's the higher commodities price. We were talking about that with Mark Cudmore, and the copper price just at the top of the show jumped, through another big figure.
There's a whole lot of gold miners as well. I think Barrick is one of them that not only produces a lot of gold, but now produces a lot of copper as well. So it's going to be interesting to see how this copper story ripples out, not just out of your kind of traditional, well-known copper miners, but into the rest of the space as well. Airbus is now falling, where it's the biggest points loss on the stock 600, down by 1.4%. But it's interesting, some of the growth stocks are coming back today quite nicely. ASML's up, Novo's up, LVMH is having a good day, SAP bouncing back as well.
Remy Cointreau is another one, rising just shy of 7%. Fourth quarter revenue beat when we talk about the luxury space, the consumer demand there.
You're going to mention premiumization, aren't you?
It's a
premiumization and luxury, two different things apparently.
Yes. I'm American. I don't know the difference.
Electrolux also gaining. So, to your point, Kriti, we're seeing some better response today to some of the earnings stories. Remy Cointreau, Electrolux stands out as well. That's actually an earnings story, but also a change of leadership story. So we'll continue to watch those businesses as those stories continue to develop. Let's just recap what we've been getting from the BOJ. Declining to comment on short-term FX moves is the latest headline that I see there. He has commented a bit on the relationship between FX, the weakness in the yen, and inflation. That has been something he's talked about. Ueda said earlier on that the impact on FX moves on inflation is usually temporary. Let's get into a conversation about this. He's still speaking in Japan, as you can see there. Mark Dowding, Chief Investment Officer for Blue Bay Fixed Income, joins us. Plenty to say about the Bank of Japan. Mark, very nice to have you with us. Let's start there, shall we? The link between the weakness in the currency and inflation in Japan. Of course, it pushes up the price of importing things like oil and a whole load of other stuff. It benefits, of course, some of the export businesses. Governor Ueda saying the impact of FX moves on inflation is usually temporary. What are your thoughts on that front?
What I think we're seeing in Japan is that inflation expectations are on the rise. I think for many years, what we've seen in Japan across society has been a pretty depressed mindset, expecting prices to stagnate and to drop. But what we're really witnessing in Japan is the fact that we've now had a couple of years or more of inflation above 2%. And I think the idea of inflation is becoming more normalised. So I think the governor is wrong here. I think that if we do see a further overshoot in inflation, this is bleeding back into inflation expectations. Remember, we've just had a wage round where wages have needed to go up more than 5%. The labour market's very tight. That'll be feeding back into wages as well. So we really do see this engine between sort of wages and prices really connecting here. And weak FX is really feeding into this. So I think the BOJ has been consistently wrong on underestimating inflation. It's going to be continue to be sort of wrong on its inflation forecast, because inflation is going to keep surprising them to the upside. And I think the FX is an important engine of that.
Okay, and just to recap where we are on the FX, 156 is where we trade on dollar yen. So the yen continues to weaken. Mark, if you think that yen weakness is going to snap at some point, are you pushing out further into the future the time when that happens, given the strength of the US economy, to some extent exceptionalism and the persistence, therefore, of those interest rate differentials? Does that point at which the yen snaps higher, I mean, does that get pushed out?
I think it certainly does. I think that in FX terms, what you're looking at is the ratio of carry relative to volatility. And at the moment, the carry advantage is way too generous. And so, in a way, investors incented to carry on selling the yen if that sort of policy gap is not closing. So obviously, with the sort of US rate expectations moving since the start of the year, that has really exposed Japan, left it in a difficult position. In a sense, it feels like sort of Japan has been out there almost praying for a US recession, praying for US rates to come down, but they're not. What we really need to see is the BOJ really adjust to that reality. But at the moment, it feels like the BOJ are slow to come to that game. In our sense, we do believe that they're now behind the curve, and they'll probably look back at this as potentially a bit of a policy error. But I think that will become clearer as inflation sort of moves higher.
Mark, you say that the Fed doesn't look like it's in the business of cutting rates. I would now price for December. Does December seem reasonable? Are we going to see any rate cuts this year?
Yeah, so on the Fed, I think it's certainly a very open question. The economy remains strong, but intrinsically, I would say that having been in DC recently, there is a clear sense that I think that Powell would like to cut rates if he's got any chance to do so whatsoever. In a way, I'm sure he would like the moniker of being the central banker that achieved the soft landing and secure his place in the Hall of Fame, so as to speak. So I think that any data excuse to cut rates and also to help Biden into the election, I think he will look to take it. So I wouldn't rule out the idea that we have a rate cut in the second half of the year. All of that said, it does require better inflation data. But just on that particular point, one of the things that we had been highlighting a few months ago, we thought that the seasonals on inflation data in the US were quite problematic in Q1. They do look a little bit better to us in Q2. So not the core PCE data today that we'll see, but maybe in a month's time, in 2 months' time, the data could look a little bit more friendly. So I wouldn't be closing the door on that possibility just yet.
But if the data remain as they are at the moment, are we in a position where the market will regard any early rate cut from the Fed as a policy mistake, i.e. the danger is that inflation becomes more embedded and you see a bigger move at the long end?
Yeah, I think in many respects, it's you do need the data to change to justify a rate cut. As I said, I think that Powell would like to cut, but he kind of needs the data to cooperate, and it's not at the moment. The truth of the matter is the US economy is moving ahead very nicely. I know that we had a weak GDP print yesterday, but that was a bit of statistical quirk that I'm very confident will end up being revised away. Many other economic indicators continue to look very robust in the US. I think in terms of the trajectory here, the baseline really is for rates kind of going nowhere. I do think the bar to a rate hike, though, remains very high. I think there'll be a real reluctance to raise rates again ahead of the election. I think inflation would need to get a lot worse for that to be on the table. So I think broadly speaking, it's staying as we are, higher for longer. But certainly what we seem to be seeing at the minute is the economy is coping A-OK with rates at this sort of level.
Mark, how are you viewing Japanese assets, though? Is the short JGB trade still at play in terms of being a hedge? Is the Japanese yen still offering that kind of value as a part of the carry trade? Do you even want exposure to Japanese assets right now, given the real lack of action from the BOJ?
Well, yes, actually, you really do want exposure to Japanese assets. On the fixed income side, you want that exposure to be on the short side. Being convinced that inflation's going to be moving higher, being convinced that the BOJ is behind the curve. I think being short JGBs continues to be a a very compelling trade to run. I continue to look at that through the lens of something that looks very asymmetric. The likelihood of yields rising is far greater than the likelihood of yields going down at this particular point. And actually, the cost of carry in being short JGBs is very little. So this is a position you can sit on, and you should be sitting on, having strong conviction that eventually yields go higher. But by contrast, you should be looking at Japanese equities and be saying, this looks great. I mean, Japan is reflating. Things are changing in Japan. There's a very bullish reflationary story to be made for Japanese stocks. I mean, pick your number on the Nikkei, but it's certainly a big one to the top side. And certainly I would have thought that this is a stock market that will continue to outperform peers. And I also think that it's interesting when I'm in Tokyo, as I was recently, meeting a lot of Japanese colleagues. A lot of them have lived in this lost generation that for a time almost gave up hope about the future. But there's a real brightening of sentiment. All of my colleagues that I know are now looking to buy Japanese stocks, buy property. They're trying to convince me to buy a condo in Tokyo as well. I'm not sure I'll be doing that, but I certainly am bullish on the stock trade. But when it comes to the FX, leave that alone for the time being. There'll be a moment when you want to buy the yen as a currency because it's really cheap, but now is not that moment.
Well, I can't ask you about Tokyo real estate, admittedly, Mark. I haven't looked into it myself. But I do want to ask you about the oil price here. When we're talking about that imported inflation coming into Japan, how much of the oil story is a leading indicator?
So, look, oil prices are being governed by their own dynamic, right? And so I think that the fact that we have the elevated geopolitical risks and situation in the Middle East is going to keep certainly a floor under oil prices, if not sort of pose an upside risk there. So I mean, the dynamic on oil is the dynamic on oil. The fact that oil is a dollar price commodity means that in Japan, which is very dependent on energy imports in terms of oil, when you translate that into yen, it means that energy inflation is going to continue to be a theme in Japan this year.
Thanks so much, Mark. Thanks for joining us. Have a good weekend when we get there. Mark Dowding, Chief Investment Officer for Bloomberg Fixed Income. We appreciate your time. Some interesting lines coming out of US Secretary of State Antony Blinken's visit to China. He is going to be meeting with the Chinese President Xi Jinping in Beijing. This conversation, we knew he was there, of course. He was there yesterday, and we knew he was staying on for conversations with top diplomats over in China. But this new information that he's going to be meeting Xi Jinping, this as relationships described by China as stabilising, but clearly a lot of negatives in those relationships as well, and a lot to talk about. So we'll continue to monitor and get an update on that later in the programme.
We will. We're watching that very carefully. Also watching what is happening with the stock story this morning. Let's take a quick look at what is happening with the core six, the stocks that we pay attention to across Europe, to just give us a steer on what the bigger picture looks like. And as you can see, we are bid across the board this morning. Nestle bouncing back after yesterday's disappointments. We've seen Schneider up. ASML is driving the markets certainly this morning. Talking of driving, Ferrari's up. They're all up. Are there any other stocks that we need to be worrying about? There certainly are. Joe Easton is watching those.
So one area that isn't catching a bid today is the aero and auto space sector, led lower by Airbus. We did get those better than expected order numbers and production numbers from the company yesterday, but the issue is the supply chains. They're not able to ramp up as quickly as expected, and as a result, the earnings estimates are lower than expected. That one down 2%. Bear in mind, it is up massively when you compare versus Boeing, the big rival. Year to date, I think Boeing nursing a loss of double-digit %, whereas Airbus going the other way. Safran, meanwhile, the engine maker, had some strong numbers out of them as well, but declining 0.9% over in France. Potentially a bit of a read across coming in there. They are actually a supplier to Airbus themselves. Valeo, this is in car parts, had some weak margins out of them over in France today. That stock coming down 2%. Brought up Continental to see if there was any read across, but at the moment that one just ticking higher. It was a little bit low. As I say, that sector looking pretty weak today. Then in terms of some other earnings, we had NatWest at 7 a.m. That one did break up 4% this morning. It has had a big rally since October. This as the outlook for the UK economy and rates does improve. Had a slump last year as the CEO unexpectedly unexpectedly left, and those net interest margins today are looking pretty firm for them. One stock seeing a big drop, though, over in Amsterdam, IMCD. This is in chemicals. It's agricultural chemicals. Seeing some weak earnings out of them this morning. That one is weighing on the chemical space. Total Energies, though, the big Total oil firm. Oil price is pretty strong at the moment, of course, so that means their earnings do look pretty strong. They're actually doing a $2 billion buyback, I saw breaking on the headlines there. And that stock just ticking higher, but has had a good run with the other energy stocks. Remy Cointreau, finally some decent numbers from the drink space. We've had a swathe of profit warnings out of drinks over the past year or so, but Remy finally seeing some better sales. Some of that in the US does seem to be stabilising for the maker of Cointreau, so that one gaining 4%. Here's the deals board. Anglo-American down 0.7%. We had an 11% gain for the stock yesterday following that unsolicited bid proposal from BHP, which they have firmly rejected today, saying it does undervalue their company. BHP's secondary listing is declining once again in London. The Australian shares fell around 5% overnight, the biggest drop in 7 months for that stock. ThyssenKrupp, Daniel Krasinski, the Czech billionaire, is going to be buying a stake in their steel business, according to a report overnight. He's the billionaire that's looking to buy the Royal Mail owner, IDS in London. So he's doing a lot of deals at the moment, got some spare cash. He's splashing it and he's buying a stake in ThyssenKrupp Steel. That one's up 9% today. Quick look at CVC, the long-awaited listing of the private equity giant over in Amsterdam. We haven't got a normal ticker price on that, but we can see there 23% gain. It did list at €14 a piece. Here's the price here, 17.25 at the moment. So investors getting a decent return on the first day of trading for CVC. As I say, the private equity firm listing. Finally, we have got a ratings change. Kering gets a downgrade, probably not too surprising, given we did see those weak earnings. Cowen is the one doing the damage, takes it down to hold, but in fact the stock gaining 2%, still down for the week, given those weak earnings earlier in the week. Keep an eye on Kering in Paris.
Thank you so much, Joe. The news coming actually faster this morning now. Joe Easton from our equities team is having a busy morning. There's that CVC listing story, which I'm glad that he got to talk about. Also want to talk to you about Darktrace, the tech business listed here in the UK, getting an offer from Thoma Bravo. And this seems to be agreed by both parties. So Darktrace agreeing to this, pleased to announce they've reached agreement on the terms of a recommended all-cash acquisition. The price on this, $7.75. If you put that into pounds, the equivalent value of the acquisition is 620 pence per share. It was certainly suspended for a moment, that one. We'll see where that one heads.
We're losing stocks fairly sort of fast and ferociously here in the UK at the moment.
It seems to be the case. We will talk more about capital markets activity. A busy day for that. Coming up, NatWest beat earnings estimates in the first quarter. We'll be discussing all of those results and the wider banking sector next. This is Bloomberg.
Twenty-one minutes into the session, NatWest shares trading a little higher this morning. This after the bank posted better than expected first quarter results. Lending and deposits actually increased amid signs of improving consumer confidence. You've seen that also in the consumer confidence data that we've seen out of the UK this morning. Sam Unstead joins us now from our Markets Today blog. In some ways, you want these numbers to be boring. You want these numbers to actually deliver nothing. And Lloyd's was very much the same, actually, I felt earlier on in the week. But on the other hand, I can't quite work out whether you want them to be exciting, because in theory, we're about to sell a whole chunk of this stuff to the public.
Yeah, specifically from NatWest's point of view, I agree. Like, you sort of need a little bit more, maybe, to kind of get excitement going in NatWest. I think their results today, you know, they were coming in with, I would say, slightly lower expectations than you had for Barclays and for Lloyds, because their net interest margins have been under a bit more pressure. Yep. And actually, for all those banks, really, the expectations have been relatively low because activity in the mortgage market's been a bit lower, higher redemptions, more people paying back their mortgages, and then also that move over to savings accounts has sort of weighed on margins a bit. So this quarter, next quarter, probably not going to provide too much excitement. but then it's later in the year when hopefully that will turn out.
Yeah, and there's a lot of volatility in our expectations around when we get cuts from the Bank of England, and that's playing havoc, no doubt, with the expectations that these banks have for their own net interest margin. I mean, we had that conversation with Venkat yesterday over at Barclays, where he's saying, you know, we were on a 90 basis point round trip. We saw those yield expectations coming down and then back up again. There's a lot of volatility in here.
There is, and actually there's an interesting comparison with Barclays. You know, so Barclays is a smaller mortgage lender, still a major one in the UK, but smaller than NatWest is, and much smaller than Lloyds. And those extra volumes mean that you do get a little bit more weakness. And actually, Barclays, their UK part of the business, did extremely well yesterday. So it seems like they're doing better on being a bit more selective about their lending within this environment where margins are a bit more under pressure, volumes are a bit more under pressure, and overall it's just sort of they're kind of waiting, as you kind of allude to, Anna, for those rate cuts to come potentially in the second half of the year.
OK, Sam, thanks so much. Sam Unser from our Markets Today blog, covering all things UK for you on that blog. You can find that blog by going to the Bloomberg UK website, or you can type TLIV Go onto the Bloomberg terminal. So NatWest, a feature of that conversation. We need to talk about technology as well.
We certainly do. Strong AI demand has been cited as a key driver for positive earnings from Microsoft and Alphabet. The CFOs of both tech giants expressing optimism in their earnings calls.
We are very pleased with our financial results for the first quarter, driven in particular by strength in search and cloud, as well as the ongoing efforts to durably re-engineer our cost base.
In FY25, that focus and execution should again lead to double-digit revenue and operating income growth. To scale to meet the growing demand signal for our cloud and AI products, we expect FY25 capital expenditures to be higher than FY24.
For more, let's get to Bloomberg's Alex Webb, who joins us with the latest on tech, and we'll throw into the mix Darktrace as well, which is another interesting story this morning. Firstly, on the big US tech names there, Microsoft and Google, how real is the AI revolution looking after these results?
I mean, at this stage, it's starting to look pretty real, like a decent chunk and a growing chunk of the growth at Microsoft Azure at its cloud business is now coming from AI. That's, you know, a consequence of the massive investments they put into data centers. That money's obviously been going to NVIDIA, a lot of it. And at Google, the cloud business, which had really been the laggard behind AWS, Amazon Web Services, that is, and Microsoft Azure, it is now really starting to make meaningful money for Google. The expectation was for $600 million or so of profit from the cloud business in the most recent quarter. In the end, it was actually $900 million, so a fairly decent beat. As far as the enterprise is concerned, there seems to be some real AI adoption happening.
When did Darktrace list?
2021.
Not very long ago. It's now been taken out by Thoma Bravo. Is it because it's a great business or because it's very cheap? I'm trying to work out what the answer is.
Well, actually, it's still quite a long way up on its IPO price. But the thing that I find quite interesting, it listed in the UK. There is a very simple path that if you're a private equity firm, then you maybe take that listing in a few years' time to the US. There was a slight overhang, of course, with Darktrace that made it harder to list in the US because one of its big shareholders was Mike Lynch, right, who is in a certain amount of legal difficulty in the US. There was some suspicion that maybe he didn't want his shareholding to be subject to US seizures, perhaps, if it was listed there. So by taking it private here, Thoma Bravo considered it for a few years. They don't spend actually a huge amount on R&D when compared to some of their peers. Cloudflare has a far higher spend on R&D. Some people therefore suspect that's why its tech might be a little bit better. They could do that for a few years, take it public in the US, and benefit from the higher multiples at which US stocks tend to trade.
A juicy one. Alex Webb, we thank you so much for walking us through some of the big tech names, plus, of course, the IPO story. And we continue the IPO story coming up. A French study by former Bank of France Governor Christian Noyer calling for urgent action to deepen European capital markets. That exclusive interview next. We're going to ask him what he recommends, how they fix the problem, maybe even his reaction to the fact that one of the biggest private capital deals this morning are happening in Amsterdam and not Paris. All that coming up next. This is Bloomberg.
Protests in France last year over pension reform were a political blow for President Macron. Still worse, savings from it were not enough to keep the fiscal deficit under control. The gap jumped to 5.5% of GDP. far higher than the official target. With slower growth, meaning lower tax receipts, the finance minister will have to find at least 20 billion euros in spending cuts in the next budget.
So now, what direction should we take? Restore our public finances, go back to a deficit below 3% in 2027. This is the commitment I'm making.
A commitment that's unlikely to be met, according to Moody's. A year ago, Fitch downgraded France one notch, citing the high level of public debt, which has jumped from around 65% of GDP 20 years ago to over 110% today.
Should rating agencies decide to downgrade France, of course, that would be something that would not be welcome, and that would prompt certainly the government to try to act on it and to design an expenditure reduction plan, or maybe a new tax increase, which is really orthogonal to what the government has been saying so far.
The pile of debt risks undermining Macron's economic credibility and could fuel support for the far-right party of Marine Le Pen. Her National Rally movement is leading Macron's party in the polls by more than 10 points as the June European election approaches.
Bloomberg's Caroline Conan reporting there from Paris on France's debt rating and the political pressure that President Emmanuel Macron is facing now. So the issues that Caroline outlined all come amid a push to deepen European capital markets and meet the massive financing needs over the coming years across the continent, all to close a widening economic gap with the United States. Now, how do you do this? Well, in a report released Thursday, former Bank of France Governor Christian Noyer identified 4 areas for action on how to accomplish that. They include developing a bigger investor base, creating a single EU platform, granting ESMA, that fiscal authority over in the EU, more oversight despite being based in Paris, and reducing fragmentation across the continent. Some lofty goals. We'll see how they're executed. Joining us now for an exclusive interview is Christian Noyer himself, the former Bank of France governor and former ECB Governing Council member. We thank you so much for making the time for us this morning. Christian, let's start with one of your recommendations here, a number that caught my eye. 1 trillion euros of funding needed by 2030. How realistic is it that we get there?
Well, basically, thank you very much for receiving me, and good morning to all. We believe that we can do it. We can do it in the European Union because we have a very high rate of savings. And simply this money is not well enough targeted. It goes too much into investments abroad and not enough into equities. So if the investor base is better reorganized with simple principles, more towards retirement and pension systems, new products, or more often transformation of existing products to make them more efficient, we believe we can move probably something like 200 billion a year towards the real needs of the economy. And also we can develop new instruments, especially securitization, to accelerate the rotation in banks' balance sheet and permit banks to lend more to where it's needed for the transition, the green transition, the digital transition that is more into the needs of corporates, equipments, and infrastructures for energy, for instance.
Christian, a lot of what you're outlining sounds very similar.
Yeah.
I was going to say, what you're outlining sounds very similar to the way that the United States functions, these pension systems, this regulation around savings, the lending story. A lot of that, however, is regulated and dictated to some extent by the SEC. I'm curious if we need a European SEC. Does ESMA serve that purpose?
Well, we believe the role of ESMA can really increase. We've done that in the banking sector for the monetary union, for the banking union. We have what we call the single supervisory mechanism that is working under the umbrella of the ECB. And we believe that ESMA could really enhance its role. It's probably not saying that all the national supervisors will disappear. They have not disappeared in the supervision of the banking sector. But ESMA should really be the the driver, the head of the single supervisory system. And what we propose is to start with big market infrastructures, the cross-border and systemic market infrastructures, where really it doesn't make sense to have a number of national regulators. And we also believe that it could develop its role progressively for the major asset managers. It would really make sense because the fragmentation of the supervision today means a lot of costs and inefficiencies.
Yeah. Christian, good morning. Do we also need a mindset shift for European businesses that have relied for a long time on bank funding rather than using capital markets? Is that at the heart of the problem? That seems to be something that's been discussed for more than a decade.
Well, it's true. It's true globally. Although there are differences between countries. For instance, in France, the share of market financing is probably close or equivalent to that of the UK. So it's not at all the American system, but it's probably something like the double of what exists in other countries. And we're not alone. It's true also in the Netherlands, for instance. So that there are already premises of the start of a possible move. But we believe we can develop that. It doesn't mean that the role of banks will disappear. They can arrange, structure, securitize part of the loans they do, and then move that to the market. But yes, it's true in a way.
Yeah.
We should move towards the model you described, the American model, or at least be on the way to change.
Yes. OK, so some kind of mindset shift. I mean, you're talking about more union here, Christian, and this has been, as we say, discussed for many, many years, how you forge more capital markets union. How do you set that in the context of European politics, where we see the rise of populist leaders in some places, not everywhere, but certainly in some places, and the idea of more integration could prove controversial?
Well, I believe that first we want to be very concrete for the ordinary people. I mean, the savers, they are interested in what they get, the return they get on their savings. What we propose would be products that would enhance the return they receive, and that can be very, very telling for the people in general. Second, we think that we have no choice anyway. If we want to finance and to find the money to finance the big investment costs for the transitions, we need to really move ahead. This is well understood across all countries. I think there is a political dynamics in the sense that we had a few days ago the report from Enrico Letta, who is well known and who produce conclusions shorter than ours, but that go in the same direction. And I don't think that this is a subject that really the populist parties will want to discuss too much. They are not so much interested by that.
Christian, good morning. It's Guy. You know a thing or two about monetary policy, so let me just get your take on what is happening. The Federal Reserve increasingly looks like it may not cut interest rates this year. How far do you think the ECB can stray and cut from the Fed if the Fed is basically on hold?
Well, I think, the ECB is in charge of a large enough monetary union to be really independent, so to say, on what they decide. I mean, what they have to do is to look after the reality of the European economy and target price stability for the European economy, for the Eurozone economy. The things may be different, and they seem to be different because the growth in the U.S. is more resilient than it has been in the EU. in the Eurozone is stronger, the level of unemployment is lower, and it's clear that the needs seen from the Fed, from the FOMC, may be different at a certain point of time. So I have no idea, or I shouldn't talk about what the ECB will do. They have to decide that, but it's not irrealistic to believe that they move at different times, even if the general movement will probably be going in the same direction, but there can be a gap of some months or quarters, depending on the circumstances of each economic and monetary zone.
Okay, that was interesting. Christian, great to catch up with you. It's interesting what you're saying about what is happening with the Capital Markets Union and the advantages that Europe could face if it were to move forward with that. I just wonder if the crisis is sufficient at the moment to make that happen. Christian Noyer, the former Bank of France governor, former ECB Governing Council member and author of this report into the Capital Markets Union here in Europe. One example, maybe, this morning of things happening in the capital markets here in Europe, CVC is listing, finally.
2 billion euros. I think this is so fascinating. This is a private equity firm, essentially, that is going public at at a time when IPOs themselves are not getting that much traction to begin with, let alone in Europe. So now to see them not only list in Amsterdam, but do it with a €3 kind of increase on their stock price, I think it's pretty substantial. I think they were initially poised for about 14 euros per share. Now trading much, much higher than that.
Yeah, up by 21% on the day. Yeah, this ties into early signs of recovery in capital markets activity. We've seen M&A from Dark Trace just this morning, Anglo-American yesterday. We spoke to CS Venkatakrishnan from Barclays yesterday. He was saying we are seeing the early signs of that uptick in capital markets activity. He wants to see another quarter or two, but he sounded hopeful.
Yeah. I would maybe differentiate between what's happening with Dark Trace being taken out, which feels like it's actually the exact opposite of what you maybe want to see here in Europe, i.e. Dark Trace is being...
I was meaning more money for bankers.
Oh, well, that's... Fair enough. Yeah, they will certainly be happy with that. But I find the Dark Trace thing is fascinating. It's a confirmation of the multiple problem. We will take this private, and then we will, to Alex's point, list it over in the States, and we will get a higher multiple on this cybersecurity company. Thank you very much.
We've got both these narratives developing at the same time, perhaps, then. A little uptick in capital markets activity, but still the structural issues around the way that Europe values, certainly the way that London values stocks right now, and therefore the pull across the Atlantic.
And isn't this the exact conversation we had with the Barclays CEO yesterday, in that he's actually dealing with an exodus of bankers, by the way, leaving Barclays. You're seeing this at the likes of other European banks as well, in addition to really compressed advisory fees. So you have UBS, you have Barclays working on these massive deals, but charging significantly less than their American counterparts for it.
The Anglo story is also a multiple story, in as much as you look at the multiples that miners trade on in Australia versus London. They're better in Australia.
And this has been the argument. As London has tried to craft all these policies to try and attract IPOs, and they haven't necessarily worked, but they've been going up, keep saying, we want to attract more tech IPOs, the likes of Dark Trace, for example. They say stuff like that, and then the commodities industry pops up and says, think about more how you keep hold of the businesses that you do have, rather than trying to attract the new ones. Maybe there's room for both.
We're going to talk about Airbus next. The company out with numbers last night. I caught up with Guillaume Faury, the CEO. I've just downgraded him. I can't believe I've done that. And we're going to talk more about what he had to say to me. They are selling aeroplanes. They're turning away customers. But the supply chain is the constraint. We'll talk about that next. This is Bloomberg.
We're operating in a complex and difficult supply chain environment, and we want to make sure that we have the resources, that we have the hardware, the equipment, and everything we need to keep ramping up in a year that will be backloaded, a bit like what it was last year.
Guillaume Faury, the CEO of Airbus, speaking to me last night about the numbers that dropped just after the European close last night. The numbers were disappointing, but you need to dig into the details. There's a bit of nuance here. Airbus is effectively turning away customers at the moment. It has so much demand that it's ramping up its production. Ramping up production means more inventory, which is hurting the cash flow story. Its costs are higher. It's still struggling with the supply chain issue that is a hangover from the pandemic and persists. Other businesses, other industries have largely solved their post-pandemic supply chain problems. Aerospace has not. And this is an ongoing problem. At the same time, you've got Boeing obviously struggling. Therefore, you're seeing even extra demand coming in for Airbus. So it's a kind of good news, bad news story. And the kind of market reflected that last night. Bit of disappointment for investors. Bloomberg's Benedict Campbell joins us now, leads our aerospace coverage. We've seen both Boeing and Airbus reporting this week. Very different problems. Let's talk a little bit about sort of Airbus, Boeing, compare and contrast. What stands out between these two businesses right now? One is really struggling, but ironically, so's the other.
Yes, you're right. In some ways, they're struggling for different reasons, though. There was one line that stuck out for me from the Airbus CEO, Faury, and he said, to some degree, we're sort of victims of our own success. And by that, he means the demand is so hot right now that we can't really keep up. And you saw some of that trickle through to the numbers. They have to build up inventory. They have to prepare for the higher build rate. That was announced yesterday on the A350 wide body. They're going to 12 a month in 2028. All those things cost money, and that's money that's rushing out of the earnings in the first quarter. So as you say, first quarter a little bit messy. They missed on the earnings, they missed on the sales. Stock's down a bit, but if you look at the shares, they've had a pretty good run this year. And then if you look across at Boeing, who reported on Wednesday, much greater problems there. Huge cash drain, really big losses at the commercial business. And then just to sort of the icing on the cake for them was for Moody's to come out later in the day and say, we're now cutting a rating by one level. They're just hovering above junk at this point. So the problem's far more pronounced at Boeing than they are at Airbus at this stage.
Well, as you point out, but Airbus also has a couple of pain points. Can you walk us through some of those?
Well, as Guy said, supply chain is still one of the big issues. Faury spoke about that at length yesterday in the interview, in the TV interview, and he said, look, we've not been able to get the people back who left us during the pandemic. This is a highly specialized industry. This is a company that is really ramping up. They're building a lot more A320s than they were a couple of years ago. As I said, they're going to 12 on the A350. During the pandemic, they barely produced a handful of them a month. So they've sort of tripled output of a very complex product. And all of these things are a strain. He did say yesterday that we are keeping a very close eye on our suppliers. And where there are issues, we come in and we help. We help with resources, we help with teams. And where we have to, we might even help with money. He didn't lay out any examples, but this is sort of shows that the issues go not just to Airbus, but really to the supply chain, which remains very strange.
Talk to me, Benny, about the Spirit Aerosystems business, because Boeing clearly trying to, buy this business at the moment, but parts of it supply Airbus, and Airbus might want to hold on to those. There's a lot to think about in this complex relationship between these three.
That's right. So we heard from the Boeing CEO, Dave Calhoun, on Wednesday, and he sounded very optimistic about reintegrating that business. So Boeing used to own Spirit. Now they want to buy it back because of the issues at that supplier. They want to gain control again. And he said, we can get this done in the second quarter. And interestingly, yesterday, Guillaume Faury said, well, actually, not so fast. The body language from him was more like, we're at the beginning of this process. He did say, we don't want to hold anyone hostage here. But they do have the cards in their hand. If they play hardball, they can make life difficult for Boeing. The assets that Spirit has that they're interested in, some of them are problematic. So they have some interest in dragging this out a little bit, shall we say, and not to sort of play nice with Boeing. So whether Boeing can get this over the line in the second half, in the second quarter, we don't know. Very different sort of language coming out of the two companies yesterday, so one to watch.
Benny, thanks so much. Bloomberg's Benedict Camel joining us there on the aviation sector, of course. One big geopolitical focus for us today is US Secretary of State Antony Blinken, who's in China. He's going to be meeting with the Chinese President Xi Jinping in Beijing. That was just confirmed within the last couple of hours. It comes as China's top diplomat Wang Yi warned Blinken that problems are mounting between the two countries, even as relations do stabilise. He delivered that message as the two met in the Chinese capital.
The China-US relationship is beginning to stabilize. Across the areas, our two sides have increased dialogue, cooperation, and the positive side of the relationship. This is welcomed by our two peoples and the international community. But at the same time, the negative factors in the relationship is still increasing and building. And the relationship is facing all kinds of disruptions.
All kinds of disruptions, then, this relationship faces. Bloomberg's Ian Marlowe joins us. He's there. He's covering Blinken's trip. He's on the ground with the US Secretary of State. He's on the phone as part of that trip. Ian, what more do we know about Blinken's meeting with Xi Jinping? That's part of the positive side of this delegation, I suppose. The fact that conversations are happening, and they're happening at a very high level.
Yeah, exactly. This meeting was only just confirmed about an hour ago. This is kind of the capstone to his trip here. The first part of the trip was a little bit more public-facing, a little bit more, trying to show a human side, going to basketball games and things like that. Now, today in Beijing, he sat down to some very tense meetings with the Chinese foreign minister who, as he played there, warned him that the negative factors in this relationship are increasing. So there's a lot of tensions here. They came with a message to get China to cut it out when it came to supplying, aid to Russia that was helping Russia with its war in Ukraine. That was a message that was never going to be particularly well received, but it was only one of many things that the U.S. side wanted to bring up, from Taiwan to North Korea to human rights and other things. So today, I think, with this meeting confirmed, Blinken is going to go into this meeting with Xi and bring a message from Biden, that this is, when it comes to aiding Russia, aiding Russia's military-industrial complex, which the U.S. and the West had tried to cripple with sanctions. The U.S. side is very concerned that the tide is turning there, in part because Chinese economic support to Russia with dual-use technologies and components, helping them rebuild their military-industrial base, that is potentially turning the tide in the war. So that's a message that's going to be very clear today. It's probably going to be delivered by Blinken to Xi himself shortly.
How much are the Chinese recognizing that we're in an election year, and to what extent does that colour the comments that are being made by the foreign minister?
Yeah, I think the Chinese are obviously close observers of the U.S. political system. They know that, the administration is under pressure to talk tough, but also acting tough when it comes to threatening new sanctions on steel and aluminum, vowing a probe into Chinese shipbuilding and other things. So I think they realize there's heat there on the U.S. side, but the Chinese side also faces a bunch of domestic challenges, from the economic slowdown to being warned by Europe and the U.S. on exporting industrial overcapacity. So they don't have so much wiggle room to retaliate, but there's a host of issues where they could retaliate. There's also this the TikTok ban that was just passed in the States. So there's a lot of stuff ricocheting around, and a lot of
certainly something we're going to be keeping a very close eye on. Bloomberg's Ian Marlowe in Beijing covering Antony Blinken's trip there as we start to see some of the rhetoric between the two nations really ramp up. That does it for markets today. The Pulse is up next. Stick with us. This is Bloomberg.